Ladies and gentlemen, welcome. This is again our seminar 4ST441, Statistical Methods and Capital Markets. And this 12th seminar is the last seminar which I am speaking to you, because on the final 13th seminar you will have to speak to me. Yeah? So this is the last lesson where I can say something to you. If you remember, on our previous seminar number 11, we talked about technical analysis, yes, and today we will continue with this issue. So there is the first important topic, yes, this index, relative strength index, which is denoted by shortcut RSI, yes. This relative strength index, yes, is an indicator that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock. Yes, so very important, overbought or oversold. Yes, two important issues. Overbought, oversold conditions in the price of a stock. This index, yes, relative strength index, is displayed as an oscillator, a line graph that moves between two extremes. Yes, are you able to imagine classical line chart or line and symbol chart? Yes, the development of line chart, oscillating. Yes, oscillating between two extremes, yes, between values from 0 to 100, yes, so oscillating chart, line chart. Traditional interpretation and usage of this index, relative strength index, are that values higher than 70, yes, values higher than 70 indicate that the security is becoming overbought or overvalued and may be primed for a trend reversal or corrective pullback in price. Yes, so values higher than 70. Yes. Values smaller than 30 indicates an oversold or undervalued conditions. Yes, so values higher than 70, values smaller than 30. Yes. Okay. So we'll move on another slide of this presentation. And we have here some formulas, yes? Relative strength index in time t for period n, yes? Do you remember when we calculated returns and log returns, yes? And we talked about the periods? This is the same, yes? Relative strength index in time t for period n, yes, is calculated like 100 minus 100 this ratio, and in this ratio we have here 100 divided by, and here in denominator is 1 plus, and in this squared parenthesis, yes, we have price in time t, yes, for period n, some value of n in time t for period n, yes. We have here, yes, the description. What is it? P in time t for period n, and how to calculate, yes, this PD. And of course, the description of nt for period n, yes. I will not read this for you now. You can silently read this at home. Yes, important is that here in this square parenthesis, as pt for period n and nt for period n is average gain and average loss. Yes, average gain and average loss. You can see that this formula, yes, which is written here, can be recalculated or can be written as in a different form, in different version, like 100 times, yes, 100 times this ratio. This ratio in numerator there is one partial ratio, in denominator there is another partial ratio, 1 plus another partial ratio, yes? So here in numerator we have price divided by n, and here there is 1 plus this ratio price divided by n, yes? So this is formula for the calculation of RSE, relative strength index, yes? You can find this in literature, and I will show to you only illustration of the development of this relative strength index, yes? We will not use the real data set, and I will not calculate this, for example, in Excel, because in practice, if you analyze the real markets, you have very often the softwares, the professional software designed for analyzing of capital market, where this development of relative strength index is calculated automatically, yes, and the chart is presented to you. So if we have calculated, yes, relative strength index, yes, either manually on the basis of this formula, yes, or automatically in some professional software designed for professional analyzing of capital markets, yes, there are some rules, yes, for decision. Again, this is a recommendation only, yes, recommendation only, so there is an option where we have a relative strength index in time t minus 1, yes, previous observation for period n is smaller than L, yes, and if relative strength index in time t for period n is higher or equal to L, this is the signal for buy, yes? This is the signal for buy. L is described here, a common choice of the lower boundary. L is L equal to 30, yes? Common choice of the lower boundary. L is a constant set on value 30, yes? Another recommendation, yes? Relative strength index in period t minus 1, so previous observation, yes? If relative strength index for t minus 1 and period n is higher than u, yes? And if relative strength index in time t for period n is smaller or equal to u, this is the signal for sell. Yes, this is the signal for sell. And again, there is a description of this constant, set constant u. A common choice of the upper boundary u is u equal to 70. Do you remember when we speak, yes, here, about this traditional interpretation and usage of relative strength index? Values higher than 70, so upper values smaller than 30, lower values, yes? So again, one more time, values higher than 70 indicate that security is becoming overbought or overvalued, and may be primed for a trend reversal or corrective pullback in price. Yes? If the value is smaller than 30, indicates an oversold or undervalued conditions. So I will return back here, yes, and there is lower and upper, lower 30, upper 70, and these two rules or recommendations. This relative strength index, yes, in practice the buy and sell signals, yes, might be more complicated, yes. It's logical, yes. There is no possible to use only one index, yes. For total evaluation, you need to use a lot of other signals, other information, yes, other tests, etc. And also your skills, your knowledges, and the practice. Yes, the practice in the real problems, in the real issues. Yes, so in practice, the buy and sell signals might be more complicated. The period N, we didn't speak already about the period. Period N is usually chosen to be n equal to 14. Yes. 14, but it can be modified individually, modified by user. Yes, various kinds of moving averages, other than simple, may be involved in the calculation of prices. Yes, for period N, and this calculated average loss, yes, n in time t for period n, yes, okay. So, relative strength index, yes, RSE, can stay in the overbought region for extended periods while the stock is in an uptrend. Yes, RSE can stay in the overbought region for extended periods while the stock is in an uptrend, and this index may also remain in oversold territory for a long time when the stock is in a downtrend. Yes, so this second issue, again very important, this index RSE may also remain in oversold territory for a long time when the stock is in a downtrend. Yes, there is a graphical interpretation. We have here the chart with open, close prices, higher and lower prices, yes, O, H, L, C chart, yes, open, close, higher, lower prices, development, and calculated index, relative strength index, yes, with the bounds, with interpreted bounds. You can see oversold, smaller than 30%, overbought, higher than 70%. Yes, we have here set the lines, the bounds, and the development of this index. Yes, many softwares, yes, producing this index automatically, and for example, if you check some development of prices, stock prices on some web pages, yes, you have also illustrated with the prices this development of RSE. Yes, it's a standard output from many professional softwares. So we can continue with other characteristic. Yes, for example, rate of change. Yes, rate of change. Rate of change is the speed at which a variable changes over a period of time. Yes, the speed of which a variable changes over a period of time. It measures the percentage change of price. Yes, it can be expressed as a ratio between a change in one variable relative to a corresponding change in another. Yes, can be expressed as a ratio between a change in one variable relative to a corresponding change in another. Graphically, it is possible, yes, again, this rate of change is possible to illustrate graphically. The rate of change is represented by the slope of a line, yes, slope of a line. Do you remember classical regression analysis, yes, from the basic course of statistics, when we calculate B0 and B1 in classical regression line, yes, we are calculating intercept and the slope of this line, yes. So B1 calculated slope, yes, of the line, or classical slope, yes, for some regression analysis. So the slope, graphically, the rate of change is represented by the slope of a line. Lower heights, every local maximum is lower than previous. Yes, lower heights, every local maximum is lower than previous, and higher lows, yes, every local minimum is higher than previous are observed. Yes, so this is important, and I will move to another slide where we have a written mathematical definition. Yes, mathematical definition. Rate of change, yes, is calculated like this ratio in parentheses, this ratio minus 1, and what is written in this ratio? Current value divided by previous value, yes? So value in time t divided by value in time t minus 1, yes? We know what is this. This is, for example, called coefficient of growth, yes, in classical statistics, yes, value in time t divided by value in time t minus 1, current value divided by previous value minus 1, yes, so this is in ratio times 100, because many people requires, yes, interpretation in percent, yes, and because we have here a multiplication by 100, interpretation can be done in percent, and this is clear for many people, yes, easy for interpretation. Rate of change allows investors to spot security momentum and other trends, yes. Rate of change allows investors to spot security momentum and other trends. A security with high momentum, yes, security with high momentum, or one that has a positive rate of change, yes, positive rate of change, outperforms the market in the short term, and it is signal to buy, yes, outperforms the market in the short term, and it is signal to buy, signal to buy. A security that has a rate of change that falls below its moving average, or one that has a low or negative rate of change, yes, is likely to decline in value and can be seen as a sell signal to investors, yes, can be seen as a sell signal to investors. This rate of change, yes, is also a good indicator of market bubbles. It's a good indicator, yes, for market bubbles, but not the only one, yes. And you have never 100% sure, yes, that you decide correctly, yes. It's only the information, yes, information for you. Okay, so we can continue. Further steps, yes, further steps. In literature, you can find many technical indicators, yes. You can find many technical indicators and trading strategies, same as the trading rules, yes. An experienced technical analyst may come up with many improvements to these rules, yes, because many people, yes, has a lot of skills in analysis of capital markets, yes, so they are able to improve, yes, they are able to improve these rules and other recommendations. In general, you can make up your own trading rules, yes. You, like investor, yes, you can make up your own trading rules. You may define various conditions under which you close your positions, yes. You may define complicated money management strategies, etc. Many of you, for example, would like to write, for example, bachelor or diploma thesis, yes, designed and prepared on analysis of capital markets, yes. So maybe one of your aim, yes, of your bachelor or diploma thesis, yes, will be setting some your own recommendation, yes, or your own rule. Yes, it's possible. In literature, you can find many modifications. So you can read, you can study this literature and try to improve something. Yes. Our next step will be to evaluate the performance of our trading strategy from the statistical point of view. Yes. This subject, yes, is mainly designed on analyzing capital markets by statistical methods. Yes. I am employee on the Department of Statistics and Probability, and this is the reason why I try to show you mainly the statistical methods, yes, which can be used in analyzing of the capital markets. But there are many other methods, not statistical, yes, but different for classification and for evaluation of capital markets, yes, and trading strategy, etc. So, measures of the trading strategy performance in general, yes, profit in dollars, yes, profit in dollars. Or in other currency, yes, but mainly in dollars, for example. Trades, the percentage of winning trades, the percentage of losing trades, yes, measured in percent, yes, or in relative number. Relative number, the value between 0 and 1, yes, after multiplication by 100, interpret in percent, yes, the percentage. Trade performance. Trade performance, average trade, yes, again, mainly in dollars or in other currency, euros, etc. Average winning trade, again, in currency, yes, in dollars and other currency. Average losing trade, ratio of average win to average loss, yes, and distribution of trade profits, yes. A lot of these statistics, yes, if you want to call this statistic or measures, yes, measurement, are calculated like simple ratio, yes? Simple ratio or simple difference. So there is no sophisticated calculation, yes? Something is interpreted in percentage, something is interpreted like a relative number. Something can be demonstrated, presented like a chart, yes? Measures for the trading strategy performance can continue per day performance, yes? Per day performance, average of 1 day simple net returns, yes? You remember when we talked about simple net return, yes? Average of 1 day simple net returns and distribution of 1 day simple net returns, yes? Temporal characteristics, moving average of 1 day simple net returns, etc. Do you remember when we talked about moving averages? Yes, calculation of a summation of few neighborhood values divided by number of values, yes, number of observation which you take into account, yes, moving average of 1 day simple net returns, etc. A comparison with a benchmark strategy such as buy and hold may be done, yes, buy and hold strategy. Okay, so now something about concluding notes. Yes, concluding notes. In practice, investors combine the methods of technical analysis. Yes, combination of methods. Yes, they never use only one issue, only one information, only one thing. Yes. But more methods as of the technical analysis. Besides, they use other stock analysis to evaluate the market, yes? Fundamental and financial analysis, psychological analysis, portfolio theory, or combination of them, yes? Fundamental and financial analysis, psychological analysis, portfolio theory, or combination of them, yes? We will also speak about fundamental analysis. What is it? Fundamental analysis is a method, yes? Method of evaluating the value of an asset or stock, yes, fundamental analysis. It analyzes the factors that could influence the price of stock in the future, yes, the factors that could influence this price. It is based on external events, factors and influences, as same as on financial statements and trends of the industry, yes? There are various tools and techniques that can be used for fundamental analysis, yes? There are two categories of the methods, yes? Top-down analysis and bottom-up analysis, yes? Maybe you heard about this fundamental analysis in other subjects, yes, at our university. It's not only used in theory of capital markets, yes. So top-down analysis and bottom-up analysis. So there we have top-down and bottom-up, yes. Top-down analysis takes a broader view of the economy, yes. It starts with the entire market and then it goes down into a sector, industry and finally to a specific company, yes. So top-down, from top to down, yes, sector, industry, and finally to a specific company, yes. Bottom-up analysis starts with a specific stock, yes, then it widens out to consider all the factors that impact its price, yes. Observed indicators are state of the economy as a whole and of the specific industry, company's revenues, earning per share, yes, it is shortcut EPS, earning per share, growth or profit margins, yes. Advantages of fundamental analysis, yes. Fundamental analysis helps traders and investors to gather the right information to make rational decisions. Yes, they base their decisions on financial data. Therefore, there is limited room for personal biases. Yes. There is limited space, yes, for personal biases based on the personal decision. Yes, fundamental analysis calculate the fundamental value of an asset, so the trader can compare it to the current market price. Yes, the trader can see whether the asset is over or undervalued. Yes, do you remember these terms, overvalued and undervalued? Yes, from previous slides. The aim is to profit from the market correction. Difference between fundamental and market value. Yes, the aim is to profit from the market correction. And of course, because I said about advantages, yes, it's good to say something about disadvantages, yes, of fundamental analysis. Fundamental analysis can be time consuming, yes, sometimes very time consuming. It requires multiple areas of analysis which can make the process extremely complicated. Yes, the process extremely complicated. As fundamental analysis takes a much longer term view of the market. Yes, the results of the findings are not suitable for quick decision. Yes, it spends a lot of time. Yes, very often. It's possible that negative economic, political or legislative changes that are not captured by fundamental analysis change the value of the asset or stock. Yes, it is possible, yes, that negative economic, political, etc. Changes, yes, also the wars, yes, abroad, etc. So these changes, these fluctuations, yes, that are not captured by the fundamental analysis, change the value of the asset, of the stock. We'll continue with psychological analysis. Yes, we hear fundamental analysis. Now, psychological analysis. Psychological analysis analyze the market psychology. Yes, the psychology of the market. It tries to explain market movement that may not be explained by other metrics, yes, such as fundamental analysis. Market psychology, yes, refers to the prevailing behaviors and aggregate sentiment of market actors at any point in time. Yes, market actors at any point in time. Market psychology describes the overall behavior of a market based on emotional and cognitive factors. Yes, emotional and cognitive factors. It assumes that the behavior of the crowd can affect the market. Yes, behavior of the crowd can affect the market. One way to view the market is as a disorganized crowd of individuals, yes, whose common purpose is to determine the future mood of the economy. Yes, common purpose is to determine the future mood of the economy, or the balance of power between optimists, as the bulls, and pessimistic, the bears. Yes, the bulls and the bears, and generate gain from a correct trading decision. Yes, correct trading decision. While individual investors typically like to think of themselves as making independent and objective decisions, yes, they are often influenced by market psychology. Yes, this is very, very important. While individual investors typically like to think of themselves as making independent and objective decisions, they are often influenced by market psychology. This is why the asset bubbles emerge. Yes, asset bubbles emerge. Herding behavior can lead to the decisions that often lack fundamental support or justification. Yes, or justification. And portfolio theory. Portfolio theory. Modern portfolio theory, with this shortcut MPT, yes, you can find it in literature, is a theory on how risk-averse investors can construct portfolios to maximize expected return based on a given level of market risk. Yes, so the theory on how risk-averse investors, yes, investors can construct portfolios to maximize expected return based on a given level of market risk. Yes. Author of this theory is Harry Markowitz. Yes, maybe you heard about this man. He wrote in 1952 a paper, Portfolio Selection, yes, Portfolio Selection, that was published in Journal of Finance in 1952 and was later awarded a Nobel Prize for his work on modern portfolio theory. Yes. Portfolio theory can also be used to construct a portfolio that minimizes the risk for a given level of expected return. Modern portfolio theory, MPT, is very useful for investors trying to construct efficient portfolios. Modern portfolio theory states that an investment's risk, and return characteristics should not be weighted down. Yes, they should be evaluated by how the investment affects the overall portfolio's risk and return. Portfolio theory shows that an investor can construct a portfolio of multiple assets, multiple assets or multiple stocks, that will maximize returns for a given level of risk. Portfolio theory shows that an investor can construct a portfolio of multiple assets that will maximize returns for a given level of risk. Also, an investor can construct a portfolio with the lowest possible risk when he knows his desired level of expected return. Based on statistical measures such as variance, yes, you know about variance, the changing of variance in time, yes, we talked about volatility models, yes, R and GAR. So based on statistical measures such as variance and correlation between variables, between two variables or more variables, yes, an individual stock's performance is less important than how it impacts the entire portfolio. Okay, so this is the end, yes. Next week we have only one topic, and this is presentation of your projects, yes. On our seminar number 10, yes, we talked about the way of the presentation, so please prepare your presentation and be ready. I will send to you email, yes, with some schedule, yes, and order of the presentation, yes. It will depend, yes, on the total number of submitted papers, because you know that today is deadline to send your paper, yes. In INSYS system, today 1 minute before midnight, yes, the system will be closed, and your paper must be submitted to study information system. After I will evaluate your papers, I will prepare a schedule, yes, and I will send to you a letter with this schedule, with the time and with the schedule of your presentation, yes. So please, if you didn't do this, so please submit your paper, and next week there will be the presentation. So this is the last seminar. Next week I will evaluate you and you will have to present, yes? Okay, so that's all for today. I hope that everything is clear. I am again sorry that everything was only theory, yes? No practice, but we had a lot of practice from week number 1 to week number 10, yes? So this is a theory, like a supplement for your education, and that's all. So this is the end. I hope that everything was clear. I wish you a nice day, and bye-bye.